Mr. Renacci.
Thank you, Madam Chairman. Just a couple quick questions. For the Mr. Buckley and Mr. Chesney, really this is regard to credit unions. Can you tell me what the percentage of your customer base is low or moderate income customers? And also, and I'm trying to frame this in total, what is the total impact of the Dodd-Frank regulations on the credit unions to raise capital? I know that's a broad question, and knowing that the credit unions raise capital, through earnings only, which is an issue, and then what is the impact of the loss of this capital or earnings, if that potentially is the case, because of these regulations on the sustaining of credit unions, which in the marketplace in the future?
Congressman, in Nuevo County, where we primarily operate, I would estimate that fully 40 to 50% of our membership would be classified as low to moderate income folks. Again, this gets back to the historical nature of employer-based credit unions and their service to people of low or modest means. With respect to the impact of Dodd-Frank and raising of capital, our concern is that we are now pitting safety and soundness concerns against a regulatory environment which by its nature is more costly than the current environment. So as regulations change or are modified and we then incur costs to change documentation, to put out new disclosures, that's every dollar of additional cost is a dollar out of my member's pocket. And that comes right out of our bottom line and out of our capital. And we don't have the means of raising capital through mezzanine financing or like that some of my fellow financial institutions on the panel might have.
And just to comment, if I might, Mr. Buckley is exactly right. Every dollar that credit unions lose in revenue or dollar that they have to spend on compliance is a dollar that comes out of the bottom line. And the bottom line of credit unions' retained earnings is the only way they can build capital in this environment. We talked about the possibility of supplemental capital, but I think at $1.5 billion in potential lost revenue, that's the difference for many credit unions if you get down to the local level. That's the difference between a continued recovery out of this economic crisis, a crisis that credit unions didn't create, and continued losses. It's a very, very severe impact in this environment.
Or the sustainability of a credit union.
Or the sustainability, yeah. Absolutely.
For Mr. Kelly and Mr. McAfee, this goes over to the small financial institutions. And again, I think everybody would agree that as regulations increase, costs go up. My concern, again, would be for the low and moderate income families that use your small institutions. And as these costs go up, what's going to be the ability to maintain checking accounts for the low and moderate income, and also the ability to maintain branches, small branches in areas where there's low and moderate income as your costs continue to decrease? If you agree, and again, I've had a number of conversations with bankers, small bankers who said these regulations are going to drive up costs.
Yeah, I couldn't agree more, Congressman. And we're in a small community where we know our customer pretty well, and if our products aren't plain vanilla in our communities. We make loans to people, and we have to fashion them to their needs. And when you get something as ominous as the interchange bill as an example that ratchets up your cost to a point where, as an example, I only make $2.28 on a transaction on each of my $1,600 cards. It's not a get-rich-quick program, and so when I lose just even that $5,000 a year in income, it's significant to our little bank, and it does affect my customers.
Congressman, I think that we finished. Congressman, I think that in Oklahoma, the counties that we are in are mostly low to moderate income areas, and so we have a tremendous concern and also respect for the people that make up that population. This debit card, certainly the debit card situation, the way that it is today, has the potential to impact them. It's either going to impact their ability to afford an account, or it's going to impact our ability to bring more money in to reinvest in our communities and do other things. We've been very mindful of trying to be sure that those folks do have banking services, and so the banks that do that, and they do traditionally do that, will have to make the decision: are we going to go ahead and reduce our ability to invest in other things like more compliance officers and eat those charges, or are we going to have to charge those people who are in those accounts? So I would hope that we're able to keep them in the bank, but it will require the banks to sacrifice more of their revenue to do so.
I think in the interest of time,